Good morning from our global headquarters in New York. I'm Danny Berger. Manish Cranny is on assignment. Welcome to Bloomberg Brief. Let's set your agenda. The jumbo unwind. The Fed opts for a 50 basis point cut, ending a historic tightening cycle. The global stock rally gathers pace. Treasury steady after a sharp post-Fed surge. Gold climbs back towards record highs. And two more decisions to go this week. The BOE and the BOJ are on deck. So we got it. We got the big boy 50 basis point cut, 11-1 decision, the first dissent since 2005. The justification seems to be we're going at 50 because we can. Inflation has been vanquished and the labor market is strong. The language Powell used is our commitment to keep the labor market there. Now, it's because of that the reaction yesterday perhaps wasn't what you would expect with a 50 basis point cut. Stocks were weaker, yields were higher, and the dollar was stronger. Good news, a lot of that is reversing this morning. The two-year yield down by 3.5 basis points. We're still pricing in maybe a 30% odds of a 50 basis point cut in the next meeting. It is off to the races with the risk appetite this morning. Again, we've undone some of that bearishness. Up 1.3% in the S&P 500 futures session. Russell 2000 futures also really strong this morning. 2.5% is where we stand on the Russell. It is a bull market reinvigorated from yesterday's cut. Also, the dollar weaker. Again, all those moves post-Fed being unwound. Euro stronger versus the dollar by 0.4%. A little breaking news to bring you as well. The Apple is facing an EU warning to open up iPhone operating systems. Again, we're going to keep track of that. It is an EU that has been very active when it comes to antitrust action. We've had a few court rulings recently, too. Apple's still higher pre-market. This probably has more to do with the Fed, up 1.4%. But again, the Apple story is they are facing an EU warning on their operating system, the EU telling them they need to be opening it up. Okay, back to the Fed. It is the end of an era. The Fed pivots, but no commitment for further cuts this year.
A broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. If the labor market were to slow unexpectedly, then we have the ability to react to that. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%.
Joining us now is Bloomberg cross-asset strategist Ben Ram. Ben, those were the words from Powell. I just want to walk through some of the market reaction because it's been quite the past 12 hours. So you first get a Powell who says you just read this as a commitment not to fall behind the curve. You see Treasury sell off, as do risk markets. But this morning, it's reversing. I know you had really acutely called that two-year yields would rise after the Fed. They did, but now they're lower. Just what do you make of that back and forth?
I don't read too much into what is happening this morning, to be honest, Danny, because, look, I mean, what is the state of play? I mean, we've got an economy that is losing momentum, but it's nowhere toppling over at the moment. Many of the markers in the labor market and indeed the wider economy are suggesting that the U.S. economy is holding fine. So this is a preemptive cut. This is reflective of a Powell who wants to ensure a soft landing. So if you juxtapose the Treasury yield moves against that, 120 basis points on the quarter is overdone. You have never seen that kind of a drop outside of an extremely systemic scenario distress kind of situation, i.e. during the global financial crisis or during the initial wave of the pandemic or during the bursting of the dot-com bubble. Outside of those periods, there's not one segment where Treasury yields have fallen so much. So we are overbought, extremely overbought on Treasuries. And let's also face that, you know, the Fed has penciled in a neutral rate of 2.9%. That's where they will get to by 2026. Now, if my own Taylor reading, parsing of the Taylor reading shows that the rate will settle somewhere around 320, which is more realistic. Given all that, if you look at the two-year yield at 358, it doesn't make sense. It needs to be somewhere around 375, 380. So it's a mild correction that we will see in the coming weeks.
Yeah, and that 2.9, I think we're priced to get there somewhere in the next year, basically summer of next year. Ben, also worth pointing out that gold is 1% higher this morning, trading around those record highs. What do you make of the moves there?
Well, on the 2.9%, I just want to say that's
please, go
what
ahead.
the Fed's median rate
Yes.
cut showed, not the market pricing. On gold, look, I mean, as long as the Fed keeps its promise of cutting rates, I think that, gold has great convexity. It's going to push higher. And if you not discounting, ignoring what's happening with the dollar this morning, if a lower dollar is going to push gold prices higher as well. So my analysis suggests that gold will reach 3,000 if the Fed cuts rate by anywhere near what its dot plot show.
Okay, Ven, thank you so much. That is Bloomberg's Ven Ram. Let's cross over now to Jane Foley, head of FX strategies at Rabobank. Jane, I want to get your take on some of these market moves, but first, just your overall thoughts on the decision and Powell's language yesterday.
Well, clearly, the economists got it wrong, and the market sort of was more right this time. But I think what we had in terms of the reaction, it told us an awful lot about market positioning. We had a very straightforward sell on the fact type of reaction in the dollar and in stocks. And I think that is now balancing out this morning. I think a lot of people in Europe would have come in this morning and looked at the prices and actually seen opportunity there. And clearly that's what's playing out today. But there was no panic, and that was perhaps a nod really to the economists' view that 25 basis points would have done. There was no panic this time around. Powell clearly just said he wanted to recalibrate that, bearing in mind where the labour market was, where inflation was. Rates just could be a little bit lower, 50 basis points lower. Unfortunately, we don't have European central banks in such a comfortable position. There is more inflation. There is more tightness in the labour market. There is more worries about wage inflation, services sector inflation. So unfortunately, that comfort with the labour market does not necessarily translate into the Bank of England, into the ECB, at least not just yet. But certainly, a pretty good position, I think, for the US economy to be in.
And to that point, Powell reiterated that over and over again, Jane, that this is a strong economy. It is a strong labor market. He said this time to support the labor market is when it is strong and not when you begin to see layoffs. That does seem like a change in tone, that they're not waiting for the labor market to weaken. They're trying to get ahead of it. Did you come out with a clear and different view of the reaction function and just understanding on where we go from here?
Well, it's difficult perhaps, to be a little bit skeptical or not to be a little bit skeptical on the political angle here. There is an election coming up. Powell's perhaps doing a little bit more than he needed to do in terms to support the economy ahead of that election. Was that politically motivated? I'd really like to say no, of course it wasn't. But, that doubt does begin to creep in. But, the US labour market has a lot more advantages in many respects to say the European labour market. It is more flexible. There is a high level of productivity. There has been high levels of immigration. And all of those things should help bring down the inflationary risks connected with the labour market. Unfortunately, in Europe, it's a much less flexible labour market. You do, of course, have less productivity across Europe and across the UK than in the US. And those sorts of things indicate that there is more of a breeding room, if you like, for inflationary forces. And I suppose, Powell was able to look at the US labour market in that sort of light and be far more relaxed about the ability of the labour market to produce more inflation.
Even if it is a better inflationary picture in the U.S., you still have an American economy that is growing quite strong. The Atlanta GDP tracker, something like 3%. So on rate differentials, I understand why the dollar would be weakening versus the euro this morning. But how does that contrast with growth between the two regions?
I think this is a really interesting question, because I actually think that the euro has been remarkably resilient this year in the face of not great fundamentals. Now, clearly, you've got countries like Spain, going very rapidly. But if you look at Germany, it really is struggling to move out of that stagnationary cloud. And those headwinds are, still very much there. We could see potentially a technical recession again for Germany this quarter. And so from that point of view, that the arguments in terms of growth are there for the ECB to loosen. But it is that stickiness in services sector inflation, which means that it has to be, really quite cautious about this. And that's sort of bad news, if you like, for many German exporters. If that translates to a more resilient euro, that's just another piece of bad news for these German exporters. So, from that front, I think Europe is certainly in a poorer position.
Jana, I'd be remiss if we didn't talk about the yen, which we're actually showing on the screen right now, ahead of a BOJ decision. how much more of a relaxed place does it put the BOJ in? The BIS came out with their quarterly basically saying the carry trade unwind hadn't happened, but you're witnessing this risk rally and not really any fear of that with the yen that is weakening this morning versus the dollar. Just how does that set us up into tomorrow's decision?
Well, tomorrow's decision isn't really about tomorrow's decision. It's first of all, is October a live meeting? And if October's not live, well, could they be hiking in December? Now, I think the data that we've had this week from Japan suggests that probably October is not going to bring an interest rate hike, but certainly, December could do and perhaps should do. And I think what the market wants is just some more pointers into validation, really, of that point of view from the Bank of Japan tomorrow. Now, clearly, dollar yen has moved an awful long way, and that sort of suggests a little bit of tightening has come back into Japan as a result of that. Now, that at this stage probably isn't unwelcome. It's probably quite welcome because I think the yen had weakened far too much when we were up at 160. But at the same time, the Bank of Japan probably don't want a rapid move down, to 130, 120 and beyond. So perhaps a more pragmatic statement tomorrow, perhaps to try and keep dollar yen where it is for the time being. But I think the market will continue to expect an interest rate hike from Japan, probably around about the turn of the year.
Jane, we really appreciate your time this morning. That is Rabobank's Jane Foley. Let's get you some other top stories that are trending on the terminal this morning. U.S. authorities have accused Iranian hackers of emailing stolen information from Donald Trump's campaign to President Biden's campaign team and to journalists. The operation happened in the summer before Biden left the race. Investigators don't have any evidence that anyone from the Biden campaign replied to the emails. Elon Musk's X skirted a ban in Brazil through a software update that changed its IP address structure. That's according to an association of Brazilian internet providers. Access to the platform returned abruptly overnight for many Brazilians. X was blocked last month in Brazil by a Supreme Court judge. Descendants of the Rothschilds banking dynasty paid around $100 million for a vineyard that they bought from the billionaire Pinot family. The vineyard is in the Chablis region of France. Even with competition from abroad, it's clear France's top-rated wine estates are still attracting a premium. Coming up, walkie-talkies explode in Lebanon. Israel says it sees a new phase in the regional war. We're going to have more on that for you next. And we'll catch up with State Street's Marvin Loh. He's keeping his expectations for QT into 2025, as did the Fed, so no reason for any change there. He's going to join us later in the hour on Bloomberg Brief.
What I can tell you is we were not involved in yesterday's incidents or today's in any way, and I don't have anything more to share. It's too soon to know if what happened over the last couple of days is going to have any effect on where we are with the ceasefire deal. Sadly, we aren't any closer to that now than we were even a week ago.
That was the U.S. National Security spokesman John Kirkby speaking after deadly blasts in Lebanon, being very stark about his remarks. The Israeli defense minister declared what he called a, quote, new phase in the war with regional Islamist groups. Israeli troops are being diverted to the Lebanese border, raising fears of a wider conflict following 2 waves of exploding devices which killed 32 people in Lebanon. For more, we're joined by Dana Krish, who leads Bloomberg's breaking news coverage in the Middle East. Dana, great to talk to you this morning. What do we know about this new phase?
Hi, yes, so what we heard from Gallant yesterday is that they are now focusing more on the security threat and the northern border in Israel. And we heard him say that the center of gravity is now moving there. So they're moving troops, their capabilities, their resources onto the northern border to focus more on that threat and what they can do to eliminate it. Israel has been preparing for war with Lebanon even before October 7. Hezbollah has always been seen as the greater threat here. And the U.S. seems to be still trying to avoid an escalation in the region, to avoid another war that would be very devastating for the Middle East and the countries involved. And it could actually just drag the U.S. and Iran into it as well. So the U.S. effort seems to be continuing, but Israel has always been and still is adamant on returning thousands of people who left from the northern border, and is now focusing more on that and seeing how to eliminate this threat.
Dana, it feels like one thing that we've stopped talking about was this idea that Iran would retaliate for what happened in the ground there with the Hamas leader being assassinated. I know in these explosions that its ambassador to Lebanon was seriously injured, and Iran said that it reserves the right under international law to take required measures deemed necessary to respond to such a heinous crime in violation. Where do we stand on this specific concern of escalation between Iran and Israel?
It seems it's still there. What we've been hearing from Iranian officials, and even today, actually, in Iranian media, is that Iran hasn't forgotten about the assassination of Ismail Haniyeh and that they will respond. In terms of what's been happening in Lebanon, I think they would leave it for Hezbollah to retaliate or to respond, because that's their territory, their turf. And it's a major security breach, not for Iran specifically, but for Hezbollah. And today, the Hezbollah chief will have a televised address later today, and will probably say that they will retaliate just to calm things down, and especially that their supporters and members are angry and very shocked at what happened, because it is an embarrassment to the group.
What is the latest on the ground in Lebanon, Dana?
Yes, so we know from the health ministry there that at least 32 people have been killed and thousands have been injured. Most of the casualties seem to be from Hezbollah members, people who work at their supermarkets, anyone affiliated with the group. And this because of not just pagers. What we saw yesterday was that walkie-talkies, fingerprint devices, even solar panels in places where supporters live and where Hezbollah holds sway or has his own centers and offices there, exploded. And this is the security breach, and this is something that Lebanon and Hezbollah is still reeling from. It seems that Lebanon as a government and Hezbollah, of course, are blaming Israel, although Israel has not confirmed or denied this, but they are insisting that it was Israel. We saw Lebanon yesterday saying that they would lodge a complaint against Israel at the United Nations. But what we're looking at today is how will Hezbollah respond to this, and what will they do to try to avoid this new warfare, this new type of warfare that they're having to deal with. And this is, of course, if it is Israel, Israel is showing what it can do without even going to war.
Right. Yeah, you'd have to imagine how tense things are, and looking at all these devices, things like walkie-talkies. Dana, thank you so much. Bloomberg's Dana Krish. Okay, let's get a quick check on markets before we head to the break. And for risk assets, it is off to the races. Even though equities fell yesterday, just look at the strength across the board. For the S&P, 1.5% higher. NASDAQ and Russell, both more than 2%. It is the small cap stocks benefiting hugely from a 50 basis point cut. Even though there are doubts on whether that pace will consider, maybe the thought is this morning, don't overthink it. You got the big cut. It's a bull market. Okay, coming up, it is the Taylor Swift effect on airlines. We're going to have more on that next on your brief. It's Bloomberg Brief, Danny Berger in New York. Time now for your front page news. Let's take a look at what's making headlines around the world besides the Fed. On the Washington Post, they lead with this. The House votes to reject a GOP bill to avert a government shutdown. So 14 Republicans joined Democrats in order to block Speaker Johnson's plan to fund the government for 6 months. That means that the funding for the federal government still expires on September 30th. Next up, this from the FT. Merger rules must help EU companies fight global rivals. That's what the new competition chief, Ribera, has said. Again, she was just appointed. She promised that merger rules will evolve to help European companies build scale to take on global rivals. She also said that she was in favor of cross-border scaling up. And then this one from us. I love this. Never far away from a Taylor Swift economic story. We had an interview with the chief commercial officer of United, who said that demand is swelling because of Taylor Swift's Eras tour. Specifically, they see a 25% increase in demand, quote, maybe more than that, on United flights after Taylor Swift's weekend concerts. And then after that, it goes right back down to normal. This is the quote from Andrew Nocella. Our demand booms wherever she goes. They haven't added flights for one of her concerts, but again, the chief commercial officer saying that they wouldn't rule it out. So, you know, the economics of Taylor Swift and all that. Okay, the economics of this bond market. The initial reaction was yields higher after the Fed's decision as Powell brushed off moves of this size. Again, maybe that was overdone. Maybe it was positioning. Yields on the 2-year lower by 4 basis points this morning. Coming up, we're going to catch up with State Street's Marvin Loh. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Manish Cranny is off in Houston on assignment. Let's set your agenda. The jumbo unwind. The Fed opts for a 50 basis point cut, ending a historic tightening cycle. The global stock rally gathers pace. Treasuries steady after a post-Fed surge in yields. Global gold climbs back towards record highs. And 2 more decisions to go this week with the BOE and the BOJ on deck. So we got it. We got the big boy 50 basis point cut, an 11-1 decision, the first descent since 2005. Why move by 50? The message was almost because we can. This is a commitment, Powell said, to not fall behind the curve. That initially meant a reaction of risk assets lower and bond yields higher. We get the opposite. This morning, it is a reversal and a strong one at that. Your S&P 500 futures up 1.5%. Small caps doing even better this morning. The Russell 2000 futures up nearly 3%. For the bull market, the read is don't overthink it, just buy. 10-year yields, those move lower, barely by a basis point, 3.69. Your 2-year yield this morning also moving lower, more significantly by 3.5 basis points. Bloomberg dollar spot, that is weaker. Asian FX, Asia dollar index at its highest, its most strong since July of 2023. The Fed opening the door for other central banks, and we have 2 more of them on deck. It starts with the BOE. That decision is today. Bloomberg's Lizzie Burden is down at the Bank of England on Threadneedle Street. Lizzie, what are we expecting?
Well, Danny, I'd love to tell you that it's going to be exciting on Threadneedle Street today. But look, the pricing's barely budged, even after that jumbo cut from the Fed last night. Why? Well, look, they already priced in a move from the BOE today to some degree when bets were ramping up of that half-point move from the Fed, when you're getting those hints in the Journal and the FT. And so after the decision, not much has changed. You could also argue that to an extent, Jay Powell's done the work for Andrew Bailey today. And the fact that he's managed to land this message on a soft landing means that the BOE doesn't need to fret today. Also, if you hone in on the UK picture, yesterday we got this spike in services inflation, which is a cause for concern for the Bank of England. We heard from Andrew Bailey at Jackson Hole, particularly cautious. So the expectation from economists is that the Bank of England will hold today. It might be a cautious hold, but that the vote split is going to be even less finely balanced than last time. 7-2 is what we're looking for, with a particular eye on Alan Taylor, the new member of the Monetary Policy Committee.
So if no change is expected on the policy rate itself, what about QT, Lizzie?
Well, this is going to potentially be the interesting part of the decision. At the moment, the asset sales pace is £100 billion a year. There has been speculation among some strategists that they could accelerate that pace so that they can restock the arsenal in case of another crisis, because the pace of sales hasn't really been doing much to rock the market. But when we hear from the likes of Michael Saunders, the former Bank of England policymaker, he says, look, there haven't really been any signs that they are going to step up the pace. And so most economists reckon they'll leave it at £100 billion. Whatever they do, Danny, though, will be watched closely by the new Chancellor Rachel Reeves as she pulls together her budget on October the 30th, because, of course, the UK Treasury picks up the losses from that QT programme.
Lizzie, thank you very much. Looking forward to your coverage of the decision. That comes in about an hour and a half's time at 7 a.m. New York time. After the BOE, we still have another decision. We're going to wrap up the busy week of rate decisions with the Bank of Japan on Friday. Let's bring back in Ven Ram. Ven, great to see you again this morning. I know it's same kind of as the BOE, that this decision, not a lot is expected, but what could we hear about the potential path of policy rates going forward from Japan?
Well, I think that, if as you said, little is expected by way of decision, not least because we've got the LDP premiership election looming large by the end of this month. So virtually guaranteed that they will not do anything to rock the boat tomorrow. But as you said, what is going to be interesting is whether they tee up a rate hike either in October or in December. At the moment, the markets are thinking there is very little chance of a hike in either of those months. But I think that the markets are complacent here to a degree which is unfathomable because, in July, we saw the Bank of Japan surprise the markets with that hike. And since then, UEDA has reiterated the message that, look, if the economy performs as forecast and if inflation keeps ticking higher, as we have seen from those wage pressures, then the BOJ is going to be hiking rates. And how far will they go? They'll probably go until 1% at the very least, which has been bandied about by BOJ policymakers as the neutral rate. So the markets are underpricing all of that possibility. So at some point, those bets will come off and, the markets will sell off again.
I know this isn't necessarily a straightforward question to answer, Ven, but you look at the dollar yen this morning, and I mean, it's being moved by the U.S. quite clearly after that decision. What is sort of the bar for the BOJ to come in and do something like rapid appreciation, like we saw from their last decision? How do you sort of delineate what's going to be the bigger driver for this currency pair?
Well, I think the bigger driver is going to be the real interest rates, the real interest rate differentials. And probably a large part of that is going to come from the U.S. side of the equation because real rates in the U.S. are going to come crumbling down in the coming months as the Fed keeps cutting rates. So the bigger impulse will still come from the U.S. side of the equation, but the BOJ adding to those hikes will also narrow those rate differentials, pushing the yen up. Let's remember that the yen is extremely cheap even at current levels. Even though it's rallied a lot since July, it's still undervalued by a whole lot because if you look at the real effective exchange rate, the yen is terribly cheap and the cheapness has to correct.
Actually, Ven, now that I'm just looking at it, I just wonder what you do make of a cheaper yen this morning, considering against most G10 currencies, the dollar is weaker, save for the yen. I know this is a very short-term sort of look, but I just wonder what you make of that.
Well, I mean, it's hard to read into those one-day volatility measures. But I think that, the longer-term trajectory is for the Japanese yen to head higher from here.
So, Ven, okay, let's take a step back because, yes, we have the BOE today, we have the BOJ tomorrow, but just generally for central banks. Now that we've gotten this 50 basis point cut from the Fed, what sort of door does it open up? What sort of policy action could we see more globally that perhaps was constrained previously? Or maybe on the flip side, what kind of headaches does it cause?
Well, I would go back to the point about BOE. I think they have room to cut rates. If you look at the Taylor rule rate, the suggested rate for UK is 250, which means that the Bank of England has got 250 basis points of rate cuts still in the works because they are only at 5% at the moment. So 250 basis points of rate cuts means that they've got plenty of room to cut rates, and they will probably pick up the pace from November onwards, possibly from the first quarter of next year as well.
Ven, we really appreciate all your analysis this morning. That is Bloomberg's Ven Ram. Okay, a quick check on markets. Again, risk assets are just really off to the races this morning. They are priced in so strong, especially for Russell 2000 futures, up nearly 3%. The Russell 2000 was one of the few indices that ended higher yesterday, but basically unchanged because we had been expecting, or some markets had been expecting, 50 basis points of cuts. Powell poured some cold water on whether that would be the pace of future cuts to come, acting as if victory was in hand, and that's why they could cut by 50 basis points, but it was a more measured approach after that. S&P 500 future session up 1.5%. Bonds largely also reversing the moves of yesterday. Yields are lower on your front end of the curve, down by 3.5 basis points. 10-year yields basically by 1 basis point. And what we have is a situation where the long end is still under pressure. Powell was very clear that QT would be unchanged, that they could still unwind the balance sheet at the same time that they are cutting rates. So that's why you have some of that pressure on the long end that's sticking around. So your 2-year yield, 3.58, 10-year yield, 3.69, and 30-year yield, 4%. Okay, coming up, we're going to talk about the latest in D.C. We'll get the latest polls for Pennsylvania. This is Bloomberg.
Politics have been gridlocked, messy, horrendously partisan. And in my travels around the world, I find that America, the U.S., is in many ways stepping on its own agenda and not presenting ourselves with the urgency of clarity and policy and support that a lot of the world needs right now.
The former U.S. Secretary of State John Kerry speaking at the Gas Tech Conference in Houston with Bloomberg's Manus Craney, which is why you're only seeing me and not him as well. So Vice President Kamala Harris leads former President Donald Trump 50 to 46% in Pennsylvania. That's according to the latest New York Times Siena poll. It also comes as the International Brotherhood of Teamsters declined to endorse either candidate. The Teamsters General President said in a statement, "Unfortunately, neither major candidate was able to make serious commitments to our union to ensure the interests of working people are always put before big business. We sought commitments from both Trump and Harris not to interfere in critical union campaigns or core Teamsters industries and to honor our members' right to strike, but were unable to secure those pledges." Joining us now is Bloomberg's David Gura. David, this has been quite significant in a manner of ways for both the Teamsters and the unions having a representation at the RNC and now not endorsing either candidate. How big of an impact will this have on the race?
They have been trying to navigate this terrain where the campaign was really upended over a couple of months. And it's the biggest union in the country, 1.3 million members. And historically, in recent history, they have supported Democrats. Now they're not. So it is a big deal. And you heard President Trump, former President Trump, last night in this rally that he gave on Long Island, referring to support he's gotten from certain parts of the Teamsters local affiliates of the union. So I think it's disappointing for both candidates, but as you heard there from the general president, they were unable to kind of reach any consensus, the likes of which they've had in past elections.
Well, I mean, is that surprising? Because we've heard so many policies being thrown out by these candidates, like a grab bag. I think Anne-Marie likes to call it an Oprah Winfrey moment of a car for you and a car for you. Yeah. And the fact that the Teamsters lead is saying that we've asked for certain things and we're not getting them.
Yeah, so it's, right to form a union is, of course, paramount, and they haven't gotten the kind of commitments they want from both of these candidates. But you get back to that kind of Oprah moment, and I think it's such a good analogy. Last night, Donald Trump was floating again kind of new tax deductions, expanding the tax deduction for state and local taxes. He's very fond now of going to different places across the country, kind of assessing what people might want or need when it comes to tax policy in particular, and devising or divining what might be the way forward for him to get support by implementing them. There isn't behind that a lot of planning about sort of how to do that and how to pay for it, and just looking at the state and local tax deduction. It was something that he eliminated himself when he passed his Trump tax cuts the last time he was in office. And if you look at analysis of what it would cost to bring those back, we're talking about $1 trillion. So yes, there is this exuberance, this willingness to do it, excitement about doing it, but there isn't kind of the policy support behind it at this point or the clarity that one would need to do it.
Speaking of Trump, I mean, he's never shy from commenting on monetary policy. We got 50 basis points yesterday, something that he said it would be a mistake to Bloomberg if they did indeed cut. So we got it. What was his reaction, David?
Yeah, so he didn't bring it up explicitly in that speech last night, but he came through the city, came through New York City on the way to giving that speech and stopped at a Bitcoin bar downtown and did address it. And so he said it's a reflection of how bad the economy is. That's his one suggestion. or that might indicate the fact that the Fed is playing politics. Of course, we heard from Fed Chair Jay Powell yesterday, this kind of very adamant, increasingly irritated response to that the Fed is fiercely independent and not doing that. I was, to be frank, a bit surprised we didn't hear more from him, knowing that it's something that he cares so much about, thinks that the Fed is kind of stacking things against him. But this was, of course, in this crucible, the last meeting that the Fed will have before the election. The next meeting takes place the day after the presidential election in November. So it's going to be seen through that political prism, even if it isn't addressed kind of as explicitly as I thought it might have been.
We also have next week the UN General Assembly happening here in New York. And of course, it's volatile times in geopolitics, which is probably an understatement. How could this also shape what we're seeing in the race?
So we have reporting that Vice President Harris is going to meet with President Zelensky when he is in the country, meet in Washington, D.C. And President Trump said it's probable that he's going to meet with him as well while they're both here. So it's an opportunity, I think, for both of these candidates to once again flex their foreign policy bona fides. And Vice President Harris has taken on some of that during the course of her time in the White House. She's gone to the Munich Security Conference, delivered some marquee foreign policy speeches. But you're right, having all of these world leaders in the U.S., in New York, but also spending time in Washington, provides them each with opportunities to kind of meet with them, be seen with them, talk policy with them, and again establish that kind of fact they're able to kind of work with them on that international scale.
David, looking forward to your coverage of it.
Thanks
so much for joining this morning. That is Bloomberg Big Take podcast anchor David Gura. Now to the geopolitics. As we'd mentioned, Israel's defense minister declared what he called a new phase in the war with regional Islamist groups. Israeli troops are being diverted to the Lebanese border, raising fears of a wider conflict following 2 waves of exploding devices, which killed 32 people in Lebanon. For more, we're joined by Bloomberg's Jomana Bersecci. Jomana, what do we know about, again, what Israel has called a new phase of war?
Yeah, that's right. So we heard from the Israeli defense minister yesterday, Yoav Gallant, saying that the center of gravity is moving north and that they are mobilizing troops towards the northern border now. And this is a quote, "We are at the start of a new phase in the war, and we must adapt." And of course, you have to take that in parallel to comments from the Israeli Prime Minister Benjamin Netanyahu that he delivered on Tuesday, saying that there is a new objective, a new war objective, and that is to return security to the northern border. Yesterday, the Israeli Prime Minister gave a very short 10-second televised comment where he said, we said we would return the residents of the north safely to their homes, and that is exactly what we are going to do. And of course, this is the first time we have heard from the Israeli Prime Minister since those series of explosions have rocked the Lebanese capital and other cities around the country. Of course, Lebanon now is on a high state of alert after those multiple days, back-to-back days of communication devices being set off.
Jomana, we really appreciate you keeping us on top of this. Bloomberg Horizons Middle East and Africa anchor Jomana Bersecci. Coming up, we're going to get to the big takeaways from the Fed's jumbo surprise cut. Surprise to some, at least to Marvin Loh. We're going to catch up with him from State Street, the senior global macro strategist, and set you up for the rest of the week and next.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
A recalibration and a commitment not to fall behind the curve. That was Fed Chair Powell at the news conference after a 50 basis point cut. Joining us now on the phone is Marvin Loh, senior global macro strategist at State Street. Marvin, can I just get your takeaway from both the decision and what we heard from Powell yesterday?
Yeah, for sure. I mean, I left somewhat confused because, ultimately understanding the Fed's financial transmission process really fell by the wayside. Recalibration with ultimately what seems like a moderate pace going into next year just don't line up. And I think if we think through how the Fed got to this 50 basis point cut, where in a lot of ways they started the year thinking they were going to cut, then in the middle of the year they thought they weren't going to cut, and then all of a sudden out of the blue they think they're going to cut again. They really are data dependent, and that's going to create volatility in the market.
He said at one point, Marvin, let me just read to you his words. The time to support the labor market is when it is strong and not when you begin to see layoffs. He said this over and over. The labor market is strong, and we are cutting by 50 basis points to support it. Should we view this, or at least do you view this, Marvin, as a real change in the way that they're managing risk?
I mean, for sure, the balance of risk has moved to the labor markets. We saw that transition occurring over the summer and certainly went full force in Jackson Hole. Kind of having said that, we are still creating jobs. Granted, we are creating less jobs than we did earlier in the year. I think some of the revisions indicate that we were probably creating less jobs than we thought based on the initial expectation. But we're still creating jobs. Overall, the economy, when we look at it from, current GDP estimates, is still above trend. So, they are reacting. There is a risk that they're reacting a little bit too much. But, for the moment, they think that they're in a solid place to start the normalization process.
Marvin, can you get into that more, the risk that they're reacting too much? What exactly is the risk there?
Well, the needle was quite small in terms of how they needed to thread it. So, clearly Powell wanted to go 50. When we kind of look at the dots, it looked like there was probably half the committee that thought that they should go only 25, like kind of this moderate 25. But not only that, but by going 50 and the whole process around letting the market, if you will, to a certain degree, dictate that they got to 50 means that the market's going to continue to push for more. And I think that, risk assets are supported from that. The Fed put is still there, but they can push around 50. And if they wind up doing more than they think they need to because the market's getting them there, we might actually loosen financial conditions when liquidity is still high and valuations are still quite high.
So Marvin, we're just about to the end of the show. So I just want to give you the last word on that point, on risk assets. Does yesterday's decision change anything for you on how you want to be allocated into this market? In just about a minute here.
Yeah, I still like risk. I think the Fed put is solid. I think the higher neutral rate and some of these discussions that are ongoing around the size of the deficit makes duration a little bit more challenging. But risk, credit, equities with the Fed put in an environment where the market could push the Fed around a little bit, should provide for a solid fourth quarter.
Marvin, thank you so much for joining us this morning. Marvin Loh in Chicago, I should say, up very, very early for us in this post-Fed session. Marvin Loh of State Street. You saw there stocks, risk assets so strong this morning. That is the notable trade of a Russell 2000 that is up nearly 3%. As to what's ahead, we're going to have a Bank of England decision that comes in about 1 hour's time. Tomorrow it is the BOJ. In the meantime, this is the picture for you. NASDAQ 100 tech also really strong this morning, up some 2%. For bonds, it is a rally on the front end, and on the long end, less certainty. QT still happening. That unwind is still occurring. It is independent of the Fed's cuts, says Powell. 2-year yields, those are down nearly 3 basis points. Your 10-year yield is unchanged this morning. So a lot of the moves we had yesterday are reversing largely. The dollar also notable in this. The euro versus the dollar this morning, stronger by 0.5%. That is trading at 111. Sterling is also stronger by 0.5% as well this morning, ahead of that BOE decision, even though they are not expected to move. Asian currencies also incredibly stronger, the strongest in a basket since July of 2023. Surveillance, it's ahead.